Hello everyone, welcome to SNS Study Station. So today we are going to start new topic, that is the time value of money. Okay, so we have seen about finance, what is finance, how we are going to manage finance, how we are going to manage money, how we will be arrange that, and where we are going to use that money when we will have it, how we are going to invest. We have seen all these things. Now there is a very important concept, that is time value of money. So here we will see there are two things which are very important. First thing is value of money. Money has some value. Whenever we want to buy something, whenever we need money to buy something, so that means that paper has some value. Otherwise, if that paper, that currency notes would not have value, we could not get anything through that. Okay, so it has some value. And second thing is time, so it changes according to time. Let's see the concept here. So money has some value and it changes according to the time. Today money has value, and after some time, after few years, it will not have the same value. It will change. Either it will increase or it will decrease. It depends, but it will change. It will not remain the same. Or if today money has some value, in the previous years also it would not be same. It was not same. So the value was different in the previous years also, today also it is different, and after few years also it will be different. So money which is available today is worth more than the same amount in the future. The money which we have today is more valuable than the money which will be have in the future. So let's say if we have 1000 rupees, if we have rupees 1000 today, so today's value is more valuable. If after 1 year that same money, suppose we have that same money, rupees 1000, okay, if today you have rupees 1000 and after 1 year also you will have rupees 1000, which one would you prefer? Today's value you will prefer, because today's money, you can, this 1000 rupees, you can invest it somewhere, you can deposit it somewhere, and you can earn interest on this 1000 and it will be increased. So if today you have 1000, after few years it will not remain the same, the value will not remain the same. Okay, its value will be changed, because in 1000 you can purchase something, a product you can purchase today. After some years, after 1 year or after 2 years or after a particular time period, you cannot purchase that same product in that same amount. You have to give more money to buy that same product after a certain time period. So that is what time value of money is. Its value changes according to the time. Okay, now whenever we have to calculate risk, we want to know what is the present value, okay, and what will be the future value if we are investing our money in a particular thing, or if we want to buy something, if we want to buy an asset, so we want to know the risk. What will be the risk, whether we are in profit or loss, okay, what we are investing today and what we will get in future. Like in investment opportunities also, today we are investing an amount, and in future we will get increased amount than what we have invested today. So is that interest correct or not, means we need to calculate that what will be its value after a certain time period. For inflation also it will be very helpful to know, to find out the inflation rate. So this time value of money, this concept is based on numericals. There will be various types of numericals which we will see how we are going to calculate the time value of money, how we are going to calculate its present value as well as future value, how we are going to calculate that. We are going to see all these things. Okay, so there are various methods for that. Let's see these methods or techniques. There are various techniques. Mainly it is divided into two parts. So first one is compounding value technique and second one is discounting value technique. Compounding value or future value technique. It can be defined by two names. Either in the question it will ask to find out the future value or it will ask to find out the compounding value. So this compounding value has two methods. First one is future value of single cash flow. When there will be a single amount for which we want to know the future value, so we will use this method. And future value of annuity is the second method. So when we will have, suppose we are investing a certain amount monthly, okay, on a regular basis, on a periodic basis we are investing a certain amount and after few years we will get some money. So present value we know, okay, what we are investing each month that we know, and we want to find out what we will get in the future. So future value we want to find out, so we'll use this method, future value of annuity. So in compounding value technique or in future value technique, we'll have these two methods where we'll find the future value. Present value will be given here, present value will be given, and future value we have to find out. What is the future value, that we have to find out. So two methods will be there. Single cash flow method will be there, okay, where only one amount, where amount is invested only one time, means one present value will be given and we want to know its future value. And future value of annuity, where amount will be invested for more than one time, means it will be invested on a regular basis and we want to know the future value. Now there is present value technique or discounting value technique. It has three methods. Present value of single cash flow, first one. So discounting value technique, basically it helps us in finding the present value. In these techniques, future value will be given and we need to find out, we need to calculate what is the present value. Okay, suppose we are going to get a certain amount after 2 years, so we want to know what is its present value. Okay, so that we will calculate through present value techniques. So first one, single cash flow. So here also one time only we are going to get an amount, we want to know its present value. Single cash flow will be there. Then second method, present value of annuity, means every year we are getting something, so we want to know the present value of all those periodic cash flows. And third one is present value of perpetuity. What does that mean? It means we are going to invest some amount and we will get money for an indefinite period of time. Suppose we have invested money in stock, we have invested money in stock, in shares we have invested money. So if we are not going to sell that stock, we will definitely get a certain dividend on that stock for an indefinite period of time, until and unless we are going to sell it. So future value, we know what we are going to get in the future, so we want to know its present value, so that we can calculate through present value of perpetuity. Means here in this present value of perpetuity, in this third method, time limit will not be given. Okay, time will not be given, there will be indefinite period of time. So this is the introduction about time value of money. I hope you have understood what is time value of money, and these are all the methods. One by one we will see problems on all these methods. So that's it for today. Thank you.